to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton. I am the Inflation Guy, and I am your host. And Happy New Year. Happy 2025. It's been more than a month since my last podcast, and I'm really sorry about that. I planned to do my usual CPI report in mid-December before stopping for the year, but I was on the road, and I forgot my microphone. I could have done this from my laptop, except I didn't have a microphone. It would have been really, really bad. As it is, my production values are pretty lame, so I didn't really feel like I wanted to make it even worse. So I hope you found the blog. If you didn't, there's a link in the show notes. If you haven't seen that, the last CPI report blog is always linked in our show notes. Anyway, back in the new year, and there's so much to talk about. Today, I'm going to have a bit of a rant about analytics, and then I'm going to kick off with a quick summary of where we are in the inflation process, sort of a summary of my last podcast, I guess, and then talk about wildfires. But first, before I get to that, a word from our sponsors. This episode of Sense and Sensibility is sponsored by Simplify ETFs, a fast-growing manager of liquid alternative ETFs. Simplify is bringing Wall Street to Main Street by providing access to institutional strategies perfect for diversifying your equity and bond portfolios, previously only available to big institutions and the ultra-rich. Check out their website at simplify.us. That's simplify.us. And you can find their entire lineup of ETFs at simplify.us/ETFs. So I thought that I would start 2025 with a little rant that's unrelated to inflation per se, but it is related to the parts of my career and parts of my persona that are analyst. So I watched a lot of football over the last month, as I'm sure many of you did as well. It seemed like every day there was 4 football games on TV, various bowl games and pros and stuff like that. And I would generally watch about 3 of them, it seemed like. But so I watched a lot of football. And one thing I heard over and over and over again, and it annoyed me every time. And I guess I don't get terribly annoyed when I watch 1 game a week, but when I watch, 20 games a week, it started to really, really irritate me. And especially seeing as how it was usually something being said by someone who majored in TV journalism. Somebody would say, the analytics say, they'd say something like, the analytics say you should go for 2 points here, or the coach is ignoring the analytics here, which say that they should punt, and so on. And it was irritating every time because analytics say nothing. Analytics are numbers. Analysts say stuff looking at those numbers and the output of programs, the output of models, and making judgments, which is why they're analysts. The judgments are really important. The analytics themselves are not prescriptive. Your analysis, your analytics may say that you should go for it on 4th and 2 at the 47-yard line when you're down by 3 points in the 4th quarter. But the analyst, maybe that's the coach, maybe he has an analytics department, whatever, understands, my team's strengths and your team's strengths, knows that we've played each other a couple of times already this year, so you're going to know my tendencies, and we already ran our best 4th and 2 play earlier, and we like our defense. So there's this game theoretic part of it as well that doesn't come out easily in the analytics. And so the analyst, the coach, decides that, punting is the better play here. And that's not automatically wrong, whatever your little analytics program spat out that said you should go for it. The analyst's job is to look at the numbers and interpret them. If we didn't need that, we wouldn't have analysts. And by the way, people are trying to get rid of analysts by thinking AI can do all this stuff, and maybe someday it can, but it certainly can't now. People who don't understand numbers, in short, they talk about the analytics like it's some sort of incantation. So instead of our best hitter, just to change my analogy totally to go to baseball, instead of our best hitter batting third, as the best hitter always batted third for the last 125 years of baseball, something like that, and our best power hitter batting fourth, teams now put the best hitter second, and the power hitter, who strikes out a lot, is the third hitter because that's what the analytics say. their modeling says that works best. But as Jimmy Breslin once said, baseball isn't statistics, it's Joe DiMaggio rounding second base. And that gets to the heart of it, is having some feel for what the hell is going on is a really, really important part of the analyst's job, whether it's baseball or football or markets. Analytics, done well, have a critical role to play. I mean, I have a daily chart package that I produce for myself every day and go and flip through it. And every time I do the CPI report, I've got a bunch of charts that I run sort of automatically. Those are the analytics. But the story that comes out of the analytics, not a story in a behavioral economic sense that you're trying to tell a story, but interpreting what that means, that's the important part. A good analyst who knows how to interpret the numbers is even more important than the good analytics. You can have the best hammer in the world, okay, and give it to me and tell me to go build a house. And I would much rather have a master carpenter with the worst hammer in the world. Much better outcome with the master carpenter than with me, even if you give me the best hammer in the world. So it's not just the analytics, it's the analyst. And we should definitely appreciate the good analysts in the world. End of rant. So Happy New Year. Let's get into the actual inflation stuff. Really sorry about that. It's one of the problems when I don't have a guest is that there's no one to rein me in. So occasionally you get the rants and I'm sorry about that. But, there's just things that occasionally people say and just, stick in your craw. There'll be an advertisement that you just really hate. And it really helps to have a podcast that you can just spill it out on. But anyway, let's get on to the more normal topic. Exciting times that we're living in, not necessarily in a good way recently. There seems to be a developing concern in many quarters that inflation might not be entirely dead after all. I mean, knock me over with a feather, right? Who could have seen this coming? I said last year a couple of times that the Fed's move to ease 50 basis points right out of the gate when they decided they needed to cut rates was probably going to age poorly. That there's really no reason to start that quickly except for politics. And that as long as Biden won, then it was okay. It wouldn't be really obvious that was what was going to happen, right? Because they could sort of finesse it. Well, now it looks just like what it was, which was a sort of the employment of monetary policy put to service for a naked political calculation, a calculation that didn't work out. But now it seems as if folks have noticed that inflation is flattening out. Median inflation is at 3.9, high threes, low fours, as I've said. Core CPI is a little bit lower than that, 3.3, but some of that's temporary and it's probably coming back. But none of that is should be surprising over the last month. I mean, that's not recent development. Those are it's been in development for a couple of quarters. Bullard yesterday, St. Louis Fed president, said that he thinks that we probably shouldn't pay as much attention to the imputed things like housing that are keeping inflation high. Okay, so he's a little bit he's on the dovish outlier side, except that it isn't housing that's keeping inflation high. It's super core services X rents. Housing is merely not plunging the way that the analytics said that it would. See what I did there? See what I did there with the analytics? Yeah. And all last year and the end of the prior year when everyone was talking about the, NTRR and ATRR and the Zillow rents, and we were going to be in housing deflation and blah, blah, blah. And I kept telling you, no, it's not just because of imputed rents. It's because those things have systematic problems to them. And rents are just not going to do that when the costs for rent for landlords keep going up. And when you have so many more people trying to go and rent apartments because we have so many new heads to put roofs over. I mean, it was really pretty simple, and yet it took folks a long time to figure it out. But but anyway, Bullard is on sort of the dovish side of things, but more and more of the Fed heads and the Fed speakers have been saying, we think that maybe inflation, maybe it's flattening out too early. We didn't expect that. Now, in my last podcast of 2024, which I'll also link in the show notes, even though it's just the last podcast, so you could just press back probably on your podcast app. My last podcast, I talked about the inflation inflection that we are now coming up to, not in terms of the direction of inflation per se, but in terms of the drivers of inflation and what's happening here. And here's the basic summary. Money velocity, which, I've been talking about this for a long time, that it's velocity was like the spring connecting the car to the trailer. And, initially that stretched out a lot as we added a ton of money, but eventually the trailer had to catch up. And the trailer has mostly caught up. But while it was catching up, it was really obvious that inflation wasn't going to come down as fast as people wanted it to come down, because velocity was going to keep rebounding. And as it did, that was going to keep inflation higher. So now I think there are velocity has now mostly finished that rebound from COVID. And there are reasons that I think that it's going to go higher, but that's sort of speculative, whereas the rebound wasn't speculative. It had to happen. Going forward, though, and this is the inflection, the question is whether the Fed recognizes that the gentle tailwinds that inflation enjoyed throughout the last quarter century, demographics, globalization, declining interest rates, that leads to declining velocity, whether that they recognize that those things have now turned into headwinds. And the implication is that instead of wanting money supply growth to be around 6% per annum, as they were, roughly 6%, 7% per annum is where M2 money supply growth has been for a quarter century. And sometimes a little bit higher, a little bit lower, but that's pretty much the average for a quarter century. And if the Fed thinks that, okay, now that we've gotten through this COVID thing, now we can get, money supply growth back to 6%, they're going to be very, very upset with the outcome. Because now all the things which were making 6% possible, 6% money growth possible without having too high inflation, those things have all reversed. And so now we really can't have more than 3 or 4% money growth if we want 2% inflation, maybe even less. And the question is, will the Fed realize that? So far it doesn't look like it. M2 growth is back to around 6%, although Fed Governor Michelle Bowman said today that she doesn't think rates are as restrictive as people think, and that's a realization in the right direction. In general, we're talking about a Federal Reserve that doesn't pay a lot of attention to money, and yet this is something they should really pay attention to, and probably the most important part of the inflation inflection question is, where does money supply growth settle in? And if it settles in at 6, we're going to have inflation in the high 3s, low 4s for a long time. Now, the good news on inflation, and there's a little bit of good news on inflation, is that the dollar over the last quarter or so has been amazingly strong. It's probably less the dollar being strong than it is the other currencies being weak, but the Fed not continuing to ease as aggressively as they'd initially signaled they were going to, probably that helps the dollar on balance. And the fact that the U.S. inflation is higher than most other developed countries' inflation, which is weird. But that also suggests that our interest rates should stay higher, which strengthens the dollar. That's part of it. But over the last quarter, the trade-weighted dollar is up about 7% since the end of September. 7%, that's a big move for a dollar against all the trade-weighted currencies since the end of September. And that, for inflation, what that means is that domestically, in terms of U.S. inflation, obviously in global inflation, we're robbing Peter to pay Paul here, but in terms of U.S. inflation, a strong currency tends to put downward pressure on a lagged basis on core goods, because we tend to import a lot of goods. Okay. And so core goods is not an enormous part. It's not as nearly as important a part of CPI as it was 40 years ago, but it's still, it's a reasonably decent sized piece, and it's the second most volatile piece behind food and energy. So it can have, because it's more volatile, it can have a bigger impact over the medium term than something like shelter, except for the fact that core goods has already been in mild deflation for a while because used cars was plunging and so on. And so I still think that used cars is going to get back to being slightly positive and then maybe go slightly whatever. But the fact that the dollar is strengthening is going to mean that core goods is not going to bounce up as far as it necessarily as it would have otherwise. And that's net a good thing. It's just that core goods was not really the driver anymore to sort of the next big inflection point. The next big move in inflation is not going to come from core goods. Anyway, but that's a positive. And now we get to the bad news, which was not bad news. It wasn't news at all when the last CPI came out, nor will it be for this next CPI coming up. But in future CPIs, we're going to have to keep this in mind, and that's the wildfires. The wildfires, obviously, they're bad in a lot of ways, and most of those ways are a lot more important than the measurement of inflation. We have huge numbers of citizens who've lost everything, and have lost their shelters, have lost everything in the shelters, have lost their livelihoods, places their jobs are gone. And at this point, as I record this podcast on January 9th, the wildfires are still effectively 0% contained. But one thing you can always count on with disasters is that you can count on economists to start talking about how the rebuilding that Los Angeles is going to have to do is going to be so great for growth. It's going to increase GDP going forward. And they always make it sound like it's a great thing, that we should just there's nothing better for GDP than destroying parts of the country and then rebuilding it. Obviously that's not true, but in terms of the GDP numbers, it's certainly the case, but it's also true that it won't be great for inflation. So whatever the GDP numbers come in and say, because we suddenly have a lot more construction happening in certain parts of the country, once the wildfires stop and we can start rebuilding, it won't be a good thing for inflation. I wrote a piece back in 2017, and I'll link this in the show notes as well. So 2017 on my blog about how Hurricanes Harvey and Hurricane Irma would affect core inflation, partly because they destroyed houses, partly because they destroyed used cars and actually removed a big overhang of cars, actually. And the effect is going to be sort of similar here in terms of the destroyed shelter. Shelter in the LA area, and incidentally, there are futures traded on the Case-Shiller Los Angeles Home Price Index, and the February 2026 contract has been steady to lower since June. I can't imagine it's going to. I would think that you should expect prices of homes that survive in the LA area to go up. You would think that with fewer homes out there, that the prices should rise, but. Anyway, shelter in the LA area is likely to rise in price because of this. There are going to be more people renting, fewer rental units available, more people renting who don't have homes, right? It's going to also be true. It's obviously true in the immediate vicinity of the fires, but also in neighboring areas and even neighboring states. So it's going to affect San Diego. It's going to affect San Francisco, because people who have connections to San Francisco will go up. It's going to affect neighboring states as well, as people, they go where the jobs are and they go where the houses are. And so it's going to affect the regional shelter sub-indices that eventually fold up into the national index. And we saw that, as I said, we saw that happen with Harvey and Irma. The effect might even be felt more widely than just regionally, because depending on the extent of the rebuilding, because if California is attracting more construction materials and crews, it means less construction materials and fewer crews elsewhere, and more pressure on those building materials, and therefore higher prices. So that's a second or third order effect, and not something that I think we'll probably be able to see in the data. But it's important to sort of think about what these pressures look like. And the bottom line is, when you destroy a whole boatload of houses and you put a lot of people out of, you remove them from shelter, and they have to get shelter, then you put pressure on the existing housing stock and on the existing stock of apartments. And that has, and while that might be great for GDP, it will push rent indices higher, and also inflation indices. It isn't something that I'd worry about with one of California's normal wildfires. I mean, this isn't like the first time they've ever had a wildfire in California, but a normal wildfire is not, it doesn't show up on the satellite view. So far, the damage estimates that I have seen have been in the $50 to $60 billion range, which is kind of similar to a Harvey Irma kind of event. But like I said, the fire isn't contained at all yet. So it's a fair bet the ultimate losses and rebuilding needs are going to be a lot higher than that. And we'll keep an eye on that as we go forward this year, because the ultimate extent of that it's going to have an impact. It's going to matter a little bit. I'm not adjusting my forecast yet for inflation, but my forecasts are already higher than most other people. And it probably will eventually affect things. Now, there's one other point that I should make, and that will be relevant to listeners, and that is market impact. Market impact of fires? Yeah, okay, so here's the thing. Markets had already been under a little bit of pressure this year, both stocks and, 10-year yields are back up to about 470, 10-year tips about 2.25, and stocks are a whopping 3% off the December highs, which, some people these days think is a bear market. And you know how I said that rebuilding is good for growth? Where do you think the money comes from for that rebuilding? Well, a lot of it comes from insurance companies. And where they get it? They get it from their general account, from the securities that they own. So $60 billion is not an outlandishly large sell program, but it's not peanuts either. And if it goes up to $100 billion or $150 billion before we're done, yeah, that starts to be something that's kind of meaningful. Now, what will they sell? It's unclear. It's unclear what insurance companies will sell to generate the cash that they need to pay claims. And there's a lot of people on Wall Street trying to figure out exactly what the insurance companies are going to sell so they can sell ahead of them. I will tell you, it's going to be liquid things. It's not going to be their private portfolio. So it's going to be stocks and bonds mostly. If it were me, if I were in charge of the GA, I would be selling my high-priced equities. If I had any Mag 7, I'd be getting out of those Mag 7. But insurance companies mark to market their equity portfolios, and while holding to maturity their fixed income portfolios. So there are tax implications for, if they sell bonds that they've bought recently, then they will be realizing a loss. By recently, I mean the last year, a couple of years. Then they'll be realizing a loss, and they're already got plenty of losses. So you would think that, recently issued bonds are probably not the ones that are going to be most likely to be sold. They don't really need those extra losses. But like I said, they mark to market there may be some bonds that they hold that do have embedded gains. But anyway, the point is that there's going to be tax implications. Large liquidations will change liquidity positions. By getting rid of the most liquid stuff, suddenly the insurance company becomes less liquid. It changes their asset allocation position. If they only sell equities, then suddenly they're fixed income heavy. and it will change their capital position because some assets get better capital treatment. The one thing that we do know is that they will be selling, and that across asset markets, you can expect at least 60, 100 billion or more of selling. And look, our asset markets are huge. And by itself, if somebody comes in and sells 100 billion in a day, then you most definitely will feel it. If they dribble it in over a long period of time, it won't necessarily be something that we can point to later and say, well, that's because insurance companies were selling a whole bunch. But I will tell you that there isn't a dealer on Wall Street that wants to, pick up the phone and hear from the insurance company, hey, can you bid a $1 billion block of the double old 10-year note? Especially when you know that there's another 10 billion behind it. So, look, I don't really need a reason to sell stocks here, but it's something to keep in mind. I don't know if that was useful at all. It's just something you always try to think about the implications, and then the second order implications, and third order implications. And then the analyst's job is to say, well, okay, how far down do we really care about these things? Where will we not? What will be so far down that we don't really notice it anymore? What should we do about this? And a lot of times, if you're a relative value strategist or a trader, what you're trying to do is not necessarily get a bet where you know the outcome, but you're trying to get a bet on where it's very unlikely to move the wrong way against you. And there's some chance it could move positively. One of the biggest trades I ever made was a trade which, if the Fed did nothing at the next meeting, and no one really expected them to do anything, then it would cost me zero. But I thought there was a small chance that the Fed would do something. Can't remember if it was easing or tightening now that I think about it. And then it turned out that they did. And so I essentially had on a position, a very large position, that had really no downside. And there was at least some chance that it worked out in my direction. Well, as an analyst, that's what we're looking for. We're looking for these asymmetric potential payoffs. And so when you see that when you think about the fact that there's going to be $100 billion seller, when you start to see, interest rates moving so that the mortgages are going to prepay faster or what have you, and so you can anticipate certain flows in the market, those are things that, particularly as a market maker, you want to keep an eye on, and it creates the possibility of asymmetric positioning in a particular trade, where even if you don't feel very strongly that it's going to work out your way, you feel fairly confident that there's no reason it's going to go against you. Anyhow, so A, I don't know if that was useful, and B, I'm not sure if my explanation about why it might be useful was useful. But either way, we're done with the first podcast in 2025. So thanks for coming along with me. That's all for today's podcast. I hope that you like it, and I hope you subscribe and you refer others. You can contact me, and some people have. I've been getting a lot of emails since I haven't been talking. At inflationguy@enduringinvestments.com. You can subscribe for free to my blog at inflationguy.blog. I'm on X at inflation_guy. And visit Enduring Investments if you have any questions, need any help with anything inflation related. But most importantly, and it's still true in 2025, if it's true in 2024, it'll be true forever. Defend your money. And if inflation is coming for you, remember, you never got it.